Hey class, welcome to chapter 3. Hopefully you should be reading your textbooks first before listening to these videos. If you haven't already, please do so. And you can have these PowerPoint presentations available for you in class. So chapter 3, we're going to analyze business transactions using T accounts. So first we're going to start with assets, liabilities, and equity. Then the next section of this chapter we'll talk about the revenue, expenses, and drawings account. So let's go ahead and get started. We'll set up T accounts with assets, liabilities, and equity, and other business transactions. So the accounting equations. So assets are the property a business owns. We went over this a little bit in the prior slide. Assets equals liabilities plus owner's equity. So the total of assets will always equal the total liabilities and owner's equity. So asset accounts show the property a business owns. So this can be cash, accounts receivable, supplies, prepaid rent, prepaid anything, other assets, as we'll see more classifications as we read more chapters. So this is something that the business owns. Liability accounts basically show the debts of the business. So we have accounts payable here, mortgage payable, accrued salaries, other accruals. We'll see more examples of that, and we'll have owner's equity accounts. Again, liabilities and equity accounts, these are claims on these assets. No in particular specific asset, just claims on the total of those assets. So this shows the owner's financial interest in the business. So T accounts. This is a really important slide. So assets. So when we have T accounts, the left side is called a debit, the right side is called a credit. No matter what type of account you have, liability, owner's equity, or assets, debit always means left, credit always means right. So more specifically for assets, if we debit an asset, we're increasing it. So if we sold our services for cash, we would debit asset. So we would debit cash, which is an asset. So we would debit the left side of the cash account. This is always the case with every single asset. If we want to decrease an asset, we report a credit. So debit's over here, credit's over here. Liabilities is opposite. So when we debit a liability, we decrease it. When we credit it, we increase it. So owner's equity and liabilities, you notice how they're on the same side of the equal sign? So they're going to be the same. So liabilities, we're going to record a decrease by debit. Same thing with owner's equity. We increase with a credit. Same thing with owner's equity. Very important. I would go through this slide or maybe pause the video now. So know that debits and credits. Debit is the left side. Credit is the right side. Debits and credits. One's not better than the other. That's the key important part here. It just depends on the type of account we're talking about. Is it an asset, is it a liability, or is it an equity account? And we'll see there's subcomponents of equity, revenue, expenses, drawing. So let's talk about the effects of the business transaction. So there's different steps when we analyze transactions. We have to look at the event. What are we actually doing? If we're hiring an employee, that's actually not an event. That's not an exchange. We're not increasing or decreasing anything. If we're buying something for the business, like supplies, we can be using cash to get those supplies, which is an asset. The supplies is an asset. The cash would be a reduction in an asset. How else can we get those supplies? Can we get those on account? That means basically an IOU. So if we did it that way, we'd be increasing an asset to get those supplies. We'll debit supplies, and we will credit accounts payable. So think about the event, analyze it, identify the accounts affected, like we just discussed. Classify the accounts affected. Is it an asset? What type of asset? Is it a liability? What type of liability? Determine the amount of increase or decrease for each amount, and we'll know that by the transaction. Hey, we paid this $50, or we're getting $50. So we'll have to. We'll get into journal entries where you have one debit, two credits, two debits, one credit. So there can be more than one debit and credit. So the book talks about apply the left side right side rules for each account. Make the entry in T-form account. So this could be as simple as writing on a piece of paper a T, labeling it cash on top. The left side is debit, right side is credit. If we're increasing cash, just say $300, we'll type in $300 on the left side of that T account. So here's an example. Carolyn Wells, so from the prior chapter, we're going along with the same example. She invested $100,000 in the business. So here's two accounts over here. This is going to be the cash account. This will be the capital account. So the left side, increase the assets accounts. Asset accounts are recorded on the left side of the T account. Right side, increases to owner's equity accounts are recorded on the right side. So we're actually, remember what I said before about debits or credits are neither good nor bad. So we're actually increasing cash here, which is a good thing. We're increasing capital here, which is another good thing. One's a debit, one's a credit. So the company issued a $5,000 check to purchase computer equipment. Let's think about this. We're giving up an asset, we're decreasing an asset, which is cash by $5,000, and we're increasing another asset by that same amount. So the accounting equation is going to still be in effect. It's actually going to be the same number if we're carrying balances like we did in the past presentation. It's going to have a net effect of 0, but we'll still record it. So the asset account is increased by $5,000, and we're decreasing cash by $5,000. So we're increasing a credit here, increasing an asset here with a debit, and decreasing an asset here with a credit. So we purchase equipment on account. So basically, this is going to be the use of accounts payable. So we would increase the asset by $6,000 and increase the accounts payable by $6,000. See how we're both increasing something, but if we increase an asset, we're on the left side. Increase a liability, we're on the left side. I'm sorry, that was the right side. Purchase of supplies for cash. So Wells issued a check for $1,500 to purchase office supplies. So they're basically spending cash to get more assets. So the supplies increased by $1,500, as we see there, and cash is decreasing by $1,500. Both asset accounts. So we're going to pay a liability. So the liability, it'll already have a credit balance, and what we're going to do is wind up reducing that, which is a good thing. So we'll see this journal entry here by we're going to be debiting accounts payable and crediting cash for $2,500. So the asset cash is decreased and accounts payable is decreased. Prepayment of rent. So when we prepay rent, say Wells sends me a check, they pay $1,000 a month, which is kind of low, but for this example, $1,000, and they send me $6,000. So that $6,000 will go on the books as an asset, and each month we'll debit prepaid expense, prepaid rent expense, and we're going to reduce the asset prepaid rent. So they issue a check to pay the rent for months of December and January. So they're going to have, so it seems like their rent is $4,000 a month by that example. So we're increasing prepaid rent by $8,000 and we're reducing cash by $8,000. We increase an asset and we decrease an asset. So an account balance is the difference between the amounts recorded on the two sides of the account. A footing is a small pencil figure written on the base of the column. Okay, so what this basically means is, just say you have an account here. You have the left side and the right side of, just say, cash. Cash normal balance is a debit. So what we're going to do is, hopefully you have more debits than you have credits. And what this is basically saying is, we're going to add up this column for all the entries. On the bottom, we're going to put a number. Then we're going to put it on the bottom, on the right side of the account, the credit. And what we'll do is, the bigger the figure, which is hopefully a debit, we'll foot the debit column. And we'll have a better example down the road with that. So here's some rules for account balances, if and then. So if the total of the right side is larger than the total of the left side, then the balance is recorded on the right side. That account would have a balance of a credit. So right means credit and left means debit. If the total of the left side is larger, that's recorded on the left side. On an account shows only one amount, that amount is the balance. An account contains entries on only one side, the total of those entries is the account balance. So here's an example, computing the account balance. So we have cash. So we have our first entry was $100,000. So we increased it. We received 100,000. Then here are all the uses of cash. So let's foot this to be 17,000. So we take 100,000 minus 17, which we see here, gives us a debit balance of 83,000. That's what footing is all about. So let's do the summary of the account balances that we actually just went through. So when we actually just did this, so this is what your T accounts, and T accounts will basically give you an overview. So basically, in reality, you're going to be looking at the general ledger. So it's a lot easier to use T accounts when teaching accounting and when actually working through problems. But basically, this is just a representation of the general ledger. So supplies. So in those if and then rules, if they had just one balance, that is the balance. Same thing with prepaid rent. Equipment we'll have to foot because there's more than one. We'll balance there. Liabilities. Remember, we paid 6,000, or we didn't pay anything. We had something on account. Then we paid down that balance, 2,500, and we have a balance of 3,500. Capital. This is the initial investment in the company. So remember the previous presentation. We kind of did the transaction analysis. Basically, assets equal liabilities plus owner's equity. So this would still be true. So here's all the assets. We have 83,000, which should be cash, supplies, prepaid rent, equipment. That totals to 1,035. Liabilities was 3,500, and equity was 100,000. The combination of these two should always equal the combination of the assets. So assets equals liabilities plus owner's equity. So section 2, basically we'll be going through the same thing, but now with the income statement accounts. So we have revenue, expenses, withdrawals. I wouldn't really say it's an income statement account. It's more of a reduction to the capital account, but just for simplification, we'll include it with revenue expenses. Here are the objectives, set up T accounts, prepare a trial balance from the T accounts, prepare an income statement, owner's equity, and balance sheet. Develop a chart of accounts. A chart of accounts is basically what an accountant does before they have that first transaction. And we'll go through that more in detail. So T account for revenue, owner's equity, we increase it with a credit. Memorize this. Revenue, we increase with a credit. Memorize that. Same thing with the assets, liabilities, and now we have equity, which and subcomponents revenue, and we should have expenses next. See how those both increase with the credit? Revenues increase equity. Increases in owner's equity appear on the right side of the T account. Good illustrations here. Therefore, increases in revenue appear on the right side of the revenue T accounts. And at the end, and we'll see in probably subsequent chapters, the revenue and expenses are called temporary accounts. They get closed out to the equity account whenever you prepare financial statements. That could be monthly, quarterly, yearly. So revenue is increased with a credit, decreased with a debit. I normally don't see a decrease in revenue unless there's like a corrective journal entry. So most likely you're always going to see this unless there was a premature. So for example, if we recorded revenue too early, we'll correct it with a decrease, but that's rare. Right side shows the increases, left side decreases. Decreases in revenue accounts are rare, like I was saying, but might occur because of corrections or transfers. Transfers, don't worry about in this class. So recording revenue for services sold for cash. So I had a balance of 83,000, which is good. That was the last transaction we did. So for G, this is a new entry. We sold something for 36,000 for cash. 36,000, increasing revenue here, increasing cash here. These are both increases. So eventually we're going to want you to get used to the T accounts, because what we're going to do next, or next step eventually, is to prepare journal entries. And we'll show examples of that. So the journal entry would say, cash over here, 36,000, indent, fees income, 36,000. So we're going to be doing journal entries for the remainder of the class when we start it, but always think in T accounts. That's a great way to start that. So sold on credit. So basically it's the same thing, but instead of increasing cash, we're going to be increasing accounts receivable. There you go. Fees income. Fees income could be revenue, sales revenue. There's no one way. So let's think about this. We could have an example in the next slide, but if we don't, it's good to think, okay, eventually that accounts receivable is going to be collected. You're going to get cash. This is basically a customer's IOU to you. So eventually, just say they paid in full, you're going to debit cash for 11,000 and credit accounts receivable for 11,000, which is basically a wash. Receipt of payments on account. So I was right. So we'll see that example here, which this is really important. The asset account cash is increased by 6,000. Accounts receivable is decreased by 6. See how we decrease it on the right side, left side? Sorry, right side. And the cash we're increasing by 6. Expenses, we increase equity like we saw in the past slides and prior slides. We decrease it with a debit. Expenses, we increase it. So increases in expenses basically decrease owner's equity at the end of the month when we prepare financial statements. Revenue increase, we decrease revenue with a debit. Payment of salaries. So we're going to pay salaries of $8,000. We're going to decrease cash and increase salaries expense. See, salaries expense right here, we're increasing it and we're reducing cash. Payment of utilities, same concept. We're going to increase an expense and decrease cash. So some more review. Now next, owner's drawing is not an expense, so it basically behaves as an expense. It's basically money coming out of the business. So you increase it just like the expense, which decreases owner's equity. You know what, let me see. Yeah, okay, so this is owner's drawing, right? So here's another example. She writes a check to herself. We decrease cash by 5, and we increase drawing by 5, which that drawing will decrease owner's capital. Rules of debit and credit. So we went over this, but I would know the increase and decrease of each account. A debit is an entry on the left side of the account, credit right side. The double entry system of accounting, again, assets equals liabilities plus owner's equity, will always be in effect. So it involves recording the effects of each transaction as debits and credits in separate accounts. Every transaction is a double entry accounting system. Let's read that again. Every transaction in a double entry accounting system has at least one debit and one credit. No exceptions. There can be more than one debit and or more than one credit, but there has to be at least one. Total of all the debits and all the credits in each journal entry will always be equal. No exceptions to that rule. Again, whether you're taking accounting 1 or accounting 10, there's no deviation from that. So any account debit and credit, debit left, credit right. Right side is always the credit, left side is always the debit. Muy importante. I would stop the video here and just review this really quick. So the assets and drawing and expense accounts have the same rules. Owner's capital, liability, and revenue accounts have the same rules. So when we prepare a trial balance at the end of each period, we take all the after we foot, we take all those balances and we create something called a trial balance. The asset accounts, then all the balance sheet accounts and the income statement accounts in order. Proper heading include the who, what, and where. You'll see examples in the text. So look at this slide and actually look at the example in the text of a trial balance and what it looks like. And here's an example. So we took the balance of the cash, accounts receivable, supplies, prepaid rent, equipment, accounts payable, the capital account drawing. That's where the balance sheet stops. And here's where the income statement starts. So revenue and expenses. So we have debit columns and credit columns, and here are basically the normal balances of each account. So the normal balance of each account is the same as what would increase it. So these are all debits, these are all assets, liability, capital, drawing. Revenues are always increased with a credit, expenses are always increased with a debit. These will always be the same, and if it's not, you'll have to go back and find an error, or maybe you forgot to record something. And this is really important for you're going to have, I think in week 3 or 4, you're going to have a project. So you can have 2 projects in the class. The first one, obviously, you're going to have to make a trial balance, and I'll be there if you guys have any questions. But start on that early. That's worth quite a few points for the class. Common errors in a trial balance. Adding trial balance columns incorrectly. Make sure you're adding them correctly. And if they're not correct, just go back and double check. It's always good to use a spreadsheet too. Recording only half the transaction, a credit but not a debit but not a credit, or vice versa. Recording both halves of a transaction as debits and credits rather than recording one debit and one credit. And the book gives good examples on this. Incorrect amount, recording the debit instead of a credit, or recording a debit for one amount and a credit for a different amount. Mathematical errors. And forgetting to carry over the trial account for the trial balance. That's a common one. So if the trial balance is prepared, the financial statements are prepared. In theory, we'll have something called adjusting entries, but we'll get to that later. Then income from the income statement is used on the statement of owner's equity. Remember how the different financial statements are ordered. First, you have the income statement, statement of owner's equity, then the balance sheet. So ending balance of the capital account is used in the balance sheet. So here's a great visual. Net income, income statement first, net income goes to here. Then we can compute the statement of owner's equity. And the statement of owner's equity basically gets... So we'll have all this information for the balance sheet. You can actually do the balance sheet, but you have to wait for this number. And you know what? You can do this, but you'll have to wait for this number. So always go ahead and do the income statement first, owner's equity, balance sheet. Chart of accounts. Each account has a number and a name. Balance sheets accounts are listed first, followed by the statement of owner's equity, then the income statement accounts. The account number is assigned based on the type of account. So 1 is going to be an asset. A revenue could be 3, 4, or 5. So here's an example. Balance sheet accounts, 1, 2, 3. Owner's equity. These aren't set in stone. So it's just an example of what chartered accounts are. Temporary and permanent accounts. So permanent account is basically in a balance sheet account. So the account that doesn't get closed, but other accounts get closed to it. For an example, capital. Income statement accounts, revenue, expenses are temporary accounts. So a temporary account is an account whose balance is transferred to another account at the end of an accounting period, whether it be a month, quarter, year. So that account is zeroed out at the end of the accounting period. So at the end of each quarter, say I made $1 million in revenue, the start of quarter two or quarter three or any subsequent quarter, that revenue goes to zero again, and we accumulate. So let me know if you guys have any questions about that. We have, I believe we have three chapters in each week. So any questions, please feel free to post in class. Thank you.